Hey everybody, welcome to Module 9.2. We're going to start this session on page 548 and 549, and we're going to look at income statements and depreciation. Okay, so from the last video, we're back with Ryan, and we're going to be going through the examples from the textbook for this module. So basically, we're trying to put together a business plan, and we're trying to see the company's future income versus the company's future expenses. So you can see that here on rows 7 to 10. This is the income that we're projecting here, or rows 8 to 10. And then down here, we're looking at expenses, 14 to 19. Basically, how much I'm going to make and how much is it going to cost. It says Ryan created the income statement worksheet to project QR Shopper's income and expenses for its first 5 years of operations. That goes the 5 years this way. Okay, and if we go down our sheet, the third thing is earnings. We have our initial earnings and depreciation, as well as our expenses, profit, and so on. Okay, so we're going to take a look at that as well. Okay, so if you're following along, open up the income statement on this sheet. Okay, so let's take a look at page 550 and 551 and take a look at the two different kinds of trends. You'll notice that there's a blue line and an orange line, and they are slightly different, right? This is because the blue line is one of the two possibilities that Ryan sees. You could read along on page 550. Ryan says that the revenue growth will be constant from one year to the next. So this year it went up 50,000, next year will go up 50,000, and so on. Or scenario 2 is that revenue will grow by a constant percentage. So based on this year's sales, we could expect a 20% increase next year. Whatever the sales are next year, which are going to be larger, it's based on a certain percentage after that. And because of that, we get a curved line like you see on the orange, right, which is called the growth trend. It's also called exponential growth. So it depends how we calculate it. Now, if you look at figure 911, it shows a linear trend and a growth trend for revenue that starts at $800,000 in year 1 and increases to 1.8 million by year 5. The growth trend lags behind the linear trend in the early stages, but it reaches the same revenue eventually at the end of the time period, right? So it basically has a different calculation of how quickly it rises, whereas the linear trend rises by a fixed amount every year. So let's do the example. Interpolation is a process that estimates the values that fall between the starting point and the ending point. So how are we going to fill those out? We're going to use autofill to pick the values for both linear growth trends. Ryan wants to estimate revenues for the first 5 years of QR Shopper. We know that we're going to start off at 800,000 in the first year, and we're going to end up at 1.8 million in the last year. And we want to figure out how much revenue will be generated if it grows by a constant amount each year. We'll try to figure out year 2 through year 4. So let's go to cell B8 with sales, and we're going to enter our first year revenue, which is 800,000, right? And then year 5, we know that we have 1.8 million, right? So now we're going to select B8 to F8 like this, and we're going to go to Home, Editing, and we're going to pick Fill, and we're going to grab Series. Okay, so we want to make sure that we're doing the row, which is going to be the row going this way, and that linear is checked. And we're going to press OK. No, sorry. First we want to click Trend. Okay, so the trend box is going to apply the trend that goes between one and the next. Otherwise, it would have gone up by $250,000 increments, which is not what we want. Okay, so I'll hit OK, and it will fill out all the boxes in between, like you can see in figure 912 on page 552. Okay, and our figures in 913 match as well. Okay, so now we're going to work on the box at the bottom of page 552. I'll go back one. We'll get rid of our values. Oops, back a little too far. There we go. Okay, now we're going to grab boxes again. we're going to go to fill. It might look a little bit different on your browser, on your copy of Excel, depending on how spread out it is. So we're going to go back to series, and then we're going to click the growth option. And we're also going to pick trend. So it's going to pick this number to this number. And we're in rows, right? We're going to press OK. So now you can see we have slightly different numbers. And let's find out why. In the growth trend, which we have now, the values change by a constant percentage each year. You can determine the percent of the change by dividing 1 year's revenue value from the previous year's revenue. For the projected revenue that we have, the values grow at about 22.5% a year. The largest revenue increase occurs at the end of the 5-year period. So for example, revenue grows by 179,000 from year 1 to year 2, but it grows by 330,000 from year 4 to year 5. Okay, so before we go on, let's just do a quick chart to see where we're at. Okay, so just for illustration purposes, it has nothing to do with the labels. I'm going to grab both rows, and we'll just throw in a quick chart, just to see what's going on. So I'll go to recommended charts. We'll take a look at this one, and very much like a textbook, and it looks slightly different because we have our numbers formatted differently. But you can basically see that we have our two series, right, ending up in the same place, but the curve is slightly different because the orange line is going at a set rate by year, and the blue line is based on an incremental change by percentage. Okay, so let's carry on. Okay, so now let's carry on where it says calculating the cost of goods sold. So we're on page 553. The next part of the income statement displays the cost of sales, also known as the cost of goods, or COGS. QR Shopper needs to purchase raw materials to create the cart scanners, and also has to invest time into development and upgrade of the software to match the changing market conditions. Ryan has estimated that every dollar of sales revenue, the customer will need to spend 13 cents on research and development and 22 cents on marketing. As the company revenue increases, these costs will also increase. The difference between the company's sales revenue and the cost of goods sold is known as the company's gross profit. Ryan wants you to project the cost of goods sold and the company's gross profit for each of the next 5 years using the estimates he provided you. So let's take a look at cell F3. So that would be over here. And we're going to put in 22% as our cost of sales and marketing. In cell F4, which is for research and development, we're going to put in 13%. In cell B9, so let's go over here, enter the formula equals B8 times $F $3. Okay, and what that's going to do is multiply year 1 revenue by the cost of goods percentage for sales and marketing. And we get back 176,000, which is the estimated cost of sales and marketing for year 1. In cell B10, so here we go, enter the formula equals B8 multiplied by $F4, $F, $4. Okay, so when we do this, when we drag down, it keeps it locked into place. And this gives us the estimated cost of R&D for year 1, right? So it's based on a percentage of the 800,000. Okay, so this number is basically taking the 800,000 and multiplying it by the 22%, and here it's doing the same thing by the 13%. Okay, and then to add these all together, in cell B11, we type in equals B8 minus, and then in brackets, we put B9 plus B10. Okay, and we get back 520,000, which is our estimated gross profit for year 1. And then we copy the formulas in B9 to B11 to C9 to F11. So that'll be down here. to calculate the cost of goods sold and the gross profit from years 2 to 5. And let's take a look at figure 915. And as if by magic, it's done. Okay, based on these calculations, the company's gross profit is projected to increase from $520,000 in year 1, so that would be over here, to $1.170 million in year 5, so that would be down here. Okay. All right, so as you probably know from your accounting classes, in the next section of the statement, we have these expenses, and the text points out at the bottom of page 554 that these expenses are fixed no matter how much product we sell. So R&D and marketing are tied into how much money we're bringing in, our sales, but our payroll, our utility bill, our licensing, etc., office space, our rent is not going to change. Okay, so let's enter in our year 1 expenses. So in the range from B14 to B19. So that would be here. Enter in the following expenses. So B14, we have $360,000. In B14, for payroll, we have $50,000. We have $25,000 for utilities. And so B16, $50,000 in B15 for utilities, $25,000 in B16 for licensing. All right. Then $45,000 for occupancy costs, $20,000 for insurance, and finally $15,000 for miscellaneous expenses. In cell B20, you'll use the sum function to calculate. So let's take a look at that. We'll type in sum, and we'll grab these guys and add them all together. Looks good. On the Home tab in the Editing group, use AutoSum, and then press Enter. Oh, sorry, I typed in a formula. Well, I hope it's the same idea. So basically, it says that the general expenses for the first year will be more than $500,000. Okay? So basically, so far, our expenses are $515, and our gross profit is $520 on sales of $800,000. Okay, so a few minutes ago, we had our year 1 and our year 5, and we interpolated what happens in between for year 2, 3, and 4, and we filled those out. Now, basically, we only have year 1 fixed expenses, and we're going to fill them out using only year 1 values. So to do that, we're going to select the range B14 to F14, so that's this whole thing right here. And we're going to go back to our Fill button, and we're going to click on Series. We're going to pick Growth, so it's going to basically increase each time as it goes along. And we're going to type in 1.13 as our step value. Okay, so we press OK, and basically we end up with, that didn't work at all. Let's try again. I realized what the problem was. I had to do B14 to F14 like that, not the whole business. Let's try again. Series, then we're going to put in 1.13, right? And we're going to pick growth, 1.13, rows. Looks good. And we'll press OK. There we go. Okay, so that brings us to step number 4. Let's try step number 5 on page 556. So now it says, go to B15, that's right here, and go down to F19, that's over here. And really important, don't grab the 20th row, which is our total general expenses. In the editing group, we go Fill, and then Series, and then we pick Growth, and we put in 1.05%. And we press OK. Will it work this time? We're about to find out. Oh my gosh, it did. Okay, so we got that going. So now it says copy B20, and we'll just move it this way. And there you go. We have, now, so keep in mind that the top row over here is basically being grown year by year at a different rate than all these other boxes, which are going at a different growth rate. Okay, but then no matter how we get the numbers from year 1 to year 5, in the end, we're adding them all together, and this is our year-by-year totals. Okay, so now that we have all of that, we're going to calculate what our initial earnings are. The text notes on page 556 that we basically went from $515,000 a year in expenses to now we have $775,000 in expenses. You know, like our premises got bigger, we had to hire more people, pay for more insurance, etc. Right? So you can see payroll-wise, especially, we went from $360,000 to almost double that. Right? Our utilities went up just by a little bit, and the rest of the things did too, because it's not that much more expensive power-wise to hire more people, but it is more expensive in terms of payroll salary. Okay, so now let's take a look at the yellow box at the bottom of page 556. We're going to go to cell B23 for year 1, and we're going to put in B11 minus B20. Okay, and that's going to give us our gross profit minus our total general expenses. And we get back our $5,000. Then we copy the formula in B23 to C23 to F23. So that would be, hang on, that would be like this. Okay, so at the beginning year 1, we basically have $5,000 of earnings between our gross profit and our total general expenses, but we increase that to almost $400,000 by year 5. Okay, and if you take a look at picture 917 on page 557, you could see that happening. Okay, so I was about to say any questions, comments, or thoughts, but this is a video, so that's probably not going to work. So I'll just keep on going. Now, if you turn back for a second to page 551, you'll remember that we talked about the difference between a linear growth, which is basically like growing in a straight line year after year, or we could say we have a trend growth that goes up by a certain percentage year after year and has more of a curve to it as our profits increase and so on. Even though they start and end up in the same place, they have a different way of getting there. And that is very similar to what we're going to be talking about next, which is depreciation. Okay, so we have two different kinds of depreciation. We have straight line depreciation, so basically the item depreciates at a fixed amount every month or every year as we go write it off towards 0. Or we have declining balance that it goes down by a percentage. Okay, so now let's just basically go through the quick version of the text on 557. We have tangible assets, which are basically like, you know, assets of the company. So for example, it says it's some material assets, like ingredients in a restaurant are not considered tangible assets because we sell them to the customer. But things like, you know, a stove, a deep fryer, or so on, we could buy, and then we could write off over time, depreciate those assets, that they're worth less and less because of wear and tear or general use and so on. So eventually, in 10 years from now, we could buy a new fryer and be more productive, or a new stove, or whatever. Okay? So the loss of the original asset's value usually doesn't happen all at once, because unless a meteor lands on your stove, nothing probably is going to happen to it like catastrophic, like, for example, getting into a car crash. But if it starts at $200,000, after 10 years of use, it might be depreciated down to $50,000, right? Because you're using it a lot, its resale value is a lot lower. Okay, so some items depreciate faster than others, which maintain their value for longer periods. In general, to calculate the depreciation of an asset, you have to know 4 things. The asset's original cost, so you bought a car for $100,000 and 5 years goes by, and so on. The length of an asset's useful life, like how long is it realistic to have this car. The asset's salvageable value, which is the asset's value at the end of its useful life. And the rate at which an asset depreciates over time. So basically, think about it. You buy a car for $100,000 today. How much will that car be in 10 years from now? And in 10 years from now, it's literally worth $500. It's like a total write-off. Nobody wants this car. You know, it's just basically not salvageable. So we would be able to figure out the calculation of how much it depreciates year by year to connect how much we paid for it initially and how much it costs when we end up with it, right? And we also need to know the number of years in between, right? Or months, or whatever the case is. Okay, so we're going to look at several different ways to depreciate assets. And that brings us to straight line depreciation. which is the formula SLN. Okay, so we have cost, salvage, and life. So the cost is our initial cost, salvage is the salvage value at the end, and life is the number of periods that we depreciate it. So it's basically very similar to the payment function that we learned about before, just a little different, right? That's the SLN function. So if you look at the example on page 558, we start off with SLN 200,000. Then after 10 years, it's worth 50,000, right? It's going to return the value 15,000, which indicates the value will decline $15,000 every year from the initial value until it reaches its salvage value, which is basically like the lowest it will go, you know, to get to the point where it's not useful anymore. And this is basically the blue line in figure 918 that you can see on page 558. Okay, we can also have another formula, which is declining balance, and that is an asset depreciates by a constant percentage rather than a constant amount. So instead of every year it's going to go down $15,000, it will go down by a certain percentage. And again, it starts off and ends off in the same place, regardless, but how it gets there is slightly different. An asset shows a greater initial decline under declining balance depreciation than under straight line depreciation. So it's like this with a car, right? Like you buy a car, you drive it off the lot, and suddenly it's worth a lot less. It doesn't go down by a fixed percentage every year. Right away, it goes down an initial big amount, and then it keeps on going down, even though the amount lessens in later years, and you end up at the same point with the salvage value in the end as you would with straight line depreciation. So basically comparing the orange line, which is what we're talking about now, to the blue line that we talked about before in figure 918 on page 558. So how do we calculate balance depreciation? We use the DB formula. Okay, so it has cost, salvage, life, period. Salvage, cost, and life are the same as we had before. So we have 200,000, 50,000, 10 periods, and then we have the cost, salvage, life, period. How many periods is it over? Let's go through that again. Where cost, salvage, and life are initial cost, salvage, and lifetime of the asset, and the period is a period in which you want to calculate depreciation. If you're calculating depreciation yearly, then the period could contain the year value of depreciation. For example, you can calculate the fourth year of depreciation and assess that decline to salvage value to 50,000 after 10 years. You would use the function. So here it's saying we start off with 200,000, we end up at 50,000. We're looking at it over 10 years, and we want to know what happens in year number 4, where we're at, right? So if I look at the chart on figure 918 and I'm counting down 1, 2, 3, 4, the fourth orange square brings me to around 125,000. And this would basically tell me that if I ran this calculation with a 4, it would give me the 125,000 mark, whereas I wrote the equation with a 3, I would get just below 150,000, which is the third orange box that you can see in figure 1.9. Okay, so let's try to enter the values of tangible assets into our worksheet. So let's go to Startup. There we go. And we'll go to B13. And we're going to enter 200,000. Yes, this is the value of our long-term assets that we're going to keep around. All right, so now we're going to go to depreciation worksheet. There we go. In cell B4, we're going to type in equals to begin the formula. And then we're going to go to the startup worksheet. Look at this. And we're going to click B13. Okay. Click cell B13 and then hit enter. Okay, so we brought over our long-term asset cost from our startup sheet. Okay, in cell B5, we're going to put in 50,000. So eventually when our equipment is no longer, you know, that useful and we want to just like sell it off, it's going to be worth 50,000 at the end. And how many years are we going to do that over? It's going to be 10 years. Okay, so next we'll do straight line depreciation. So we're going to do that we're going to click in cell B10, and we'll enter this formula, equals SLN, returns the straight line depreciation of an asset for one period. So first we're going to start with cost, and that's going to be $B, $4, comma, $B, $5. And then last one, we're going to do here, 6. Now, I'm sure I've told you this before, but if you highlight everything and you press F4, it'll add dollar signs to everything if you give it a couple clicks. There we go. Okay, and I'll hit enter. So that's going to give us the straight line depreciation for year 1 based on the value of the salvage, the cost value, the salvage value, and the life value in cells B4, B5, and B6. This gives us a depreciation value of $15,000. That means in year 1, it's going to be worth $15,000 less than it was. So it's going to be $200,000 minus $15,000. And let's copy this formula in cell B10, and we'll copy it in C10 to F10. So we'll drag it across like that. Did that work? It did. All right, let's keep on going. Okay, so let's take a look at the number 2. It says it's the same every year because straight line depreciation is a constant amount. Remember, this is the one with the straight blue line, right? That means that every year it goes down by 15,000. It all ends up at the same place. So it's basically going from 200,000 to 50,000 by fixed increments. Okay, let's keep on going. We're up to step number 3. In cell B11, that's here, enter the formula equals B10 to display the depreciation for the first year. And in C11, we're going to do equals B11 plus C10. All right. Copy the formula in C11 to the range D11 to F11. So we'll drag it down like this. Okay. To calculate the cumulative depreciation through the first 5 years. By year 5, the asset's value will have declined by $75,000. All right, so now what's happening is that here we're adding, even though it's $15,000 each year, in year 2 it's $15,000 plus $15,000, right? And in year 3, the $45,000 is actually these 3 added together. Okay, so we get to our cumulative total, all these years added together, is now $75,000 in year 5. Next, we're up to step 6 on page 560. In cell B12, enter the formula equals, and we'll do dollar signs here, $B, $4, because again, we don't want B4 to move because that's a constant, minus B11, which is not a constant. And we're going to take a look at the first year. We'll hit enter, and we're going to get our $185,000 left over. Now we're going to drag from B12 this way. Okay, so basically our cumulative depreciation, so all of these added together is $75,000. 200,000 minus the 75,000 gives us a balance of 125,000. Now we're going to click on cell B10. Deselect the copied range. I don't know what that means, but I guess we're good. I'm not 100% sure what they're talking about. Click on cell B10 to deselect the copied range. Don't know, but hopefully that's what they want. Ryan also wants to explore the depreciation of the company's tangible assets under the declining balance depreciation method. Okay, now in case you're wondering why we're only at 125,000, that's because we're looking at these numbers over 10 years, but we only calculated for 5 years. Okay, so if we extended this, after 10 years, we'd be down to 50,000. Right, because 10 times 15,000 is 150,000, and deducting our salvage value would leave us with the 50,000. Okay, so next let's try the same thing with declining balance. So for this one, we're on page 561. We click on B16, and we put in equals DB, and returns the depreciation using a declining balance. Okay, so now we need to put it in our cost. So I'm going to do $B, $4, $4, there we go, which gives us our cost. Next we do $B, $5, which gives us our salvage value. $B, $6 is the period, which is going to be 10 years. And then the last part is we want to put in B15, period number 1. Okay, because remember, this is showing us along each year where we're at. So we'll press enter, and we get 25,800. That's the amount the assets will depreciate for year 1. Let's copy that formula from B16 to F16. So we'll go this way. And in year 5, we end up with 14,849, so that's good. Copy the formula from B11 to F12. B11 to F12. And let's paste those in here. Interesting. Okay. So we end up with 100,258, which is correct. So basically here, we're just adding these, we're adding long-term cost. Okay, sorry. In the total, we're taking our cumulative depreciation, which is all of these added together, giving us 99,742, taking that and deducting it from our 200,000, and we're left over with 100,000. Okay, so we could see here that the curve is greater for depreciated asset value. So using straight line, after 5 years, it's still worth $125,000, whereas with declining balance, it's actually worth only $100,000, so it's worth less. But ultimately, after 10 years, they're both going to end up in the same spot. Okay, and you can take a look at the functions with the descriptions on page 562. Okay, so let's keep on going. We'll do the next few activities. Next, we're going to do adding depreciation to an income statement. So depreciation is part of a company's income statement because even though we're not losing actual revenue, we're losing worth because now our stove or car or whatever is worth less money. And because assets decline in value, it reduces our tax liability. So we don't have to pay tax on that amount because we're basically doing what they call writing it off. Ryan wants to add some declining balance depreciation figures to the depreciation worksheet to the projected income statement to project the company's operating profit, which represents the company's profits before calculating its tax liability. All right, so to do that, let's go over to our income statement. So that's over here. And we're going to click on cell B24. And we're going to type in equals. And then we're going to go over to the depreciation sheet. And we're going to click on cell B16. That's going to be over there. And hit enter. Okay, it looks good. Copy the cell B24. We're going to bring it out this way. Okay, that looks good. And this is the annual depreciation for year 1 to year 5. In cell B25, which is our operating profit, we're going to put in equals B23 minus B24. And that subtracts the depreciation for the company's initial earnings. QR Shopper shows a loss of an operating profit for $20,800 in the first year. Copy the formula in cell B25 to C25 to F25. Ah, we did that. Okay. So we end up with 379,777, but in year 1 we start off with a loss of 20,800. Okay, let's carry on. We're at the bottom of page 563, and now we're going to do the adding taxes and interest expenses to an income statement. Interest expenses are part of an income statement. We already projected the annual interest payments for the company to have made $400,000 on a loan, and that was on row 36, figure 9.9. Okay. Rather than re-enter these values, you can reference the calculated values from that worksheet in the income statement. Because those values were displayed as negative numbers, we have to flip them and change the sign to match the format of the income statement. So let's go to cell B27. So that's going to be over here. We're going to type in equals negative. So if the number is a negative, it will flip it. to begin the formula. Then we're going to go over to loan schedule and click on cell B36 right here. And we'll hit enter. The formula minus negative loan schedule B36 is entered in the cell, and we should get back 18,659, and it worked. In cell B28, enter equals B25 minus B27. There we go. Okay, so next we're going to copy B27 to B28. So that would be these guys. And we're going to copy them over this way. Okay, so by year 5, our interest expense is going to be $2,772, and our pre-tax profit will be $377. Basically, this number minus our interest expense. Whereas on this side, we are now going to have $18,659 we're going to pay in interest, and our pre-tax profit is now negative almost $40,000. Not very great for our first year in business. Okay, so now we're on page 564. When interest is considered, the company's pre-tax profit is $377,006. So that is down there. But we are going to lose almost $40,000 our first year. All right, so last job Ryan wants us to do. Finally, you need to account the taxes the company will pay on the money it will make. Ryan estimates the company will be subject to a 32% tax rate on its pre-tax income. We need to add this tax onto the income sheet worksheet and then calculate the company's tax liability. The company will pay taxes only if it makes money, so we're not going to pay tax in the first year. So we have to use an if function to test whether the pre-tax income is positive before calculating its tax liability. If it's negative, the taxes owed will be 0. So let's go to the statement worksheet. Where'd it go? I don't know what I was thinking there. But okay, we're on the income statement. And we go to cell F5. So that's up here. And our assumed tax rate is going to be 32%. Okay, we'll enter that up here at the top. Okay, so now let's go to B30. And we're going to type in an if formula equals if B28 is greater than 0, then B28 should be multiplied by $F $5, which is our tax rate. Otherwise, we'll just go with 0. Okay, so it's 0 for our first year because it's a negative number. It's less than 0. Otherwise, we will multiply it by the rate. So let's go to cell B31, our after-tax profit, and we'll type in equals B28 minus B30. Okay, we'll hit enter. And right now, because we're not paying any tax, it's the same. Okay, so now we'll grab these two guys and copy them over this way. Okay, so let's take a look what happens in year 2. Our tax liability is going to be at 32%, and on the basis of having a pre-tax profit of $29,867, our tax liability is going to be $9,558. So then our after-tax profit is going to be this. And we can see the same thing happening here, and we end up with $256,364. Okay. So let's look at our last step. We're at the bottom of page 564. It says, with the initial financial planning laid out, the company needs to attract more investors. And then we're going to look at the return on investment the company is able to offer investors and the impact it's going to have on the company's profitability. So as of where we are right now, basically in year 1, we're ending up with a loss of $39,000 after tax, and our after-tax profit in year 5 is projected to be $256,364. Okay, so that wraps it up for 9.2. Next, we're going to cover 9.3 and look at return on investment. And we're also going to have an important module on finding errors when we put in formulas.